Financial crises keep repeating, even when everyone sees them coming early, somehow still anyway. Markets always look calm, right before everything suddenly falls apart completely again today. Everyone reads warnings, yet believes this time is different, somehow again, still anyway. The strange truth is, awareness never stops repetition in financial systems at all. History is full of crises that felt predictable only afterwards, every time, always. Cheap money hides risk beneath surface until pressure eventually breaks everything again, suddenly. Leverage builds quietly for years before collapsing all at once, violently, every cycle. Even experts managing billions misjudge timing more than actual direction, always, repeatedly so. Systems break slowly, then all at once, without warning anyone watching closely enough. Confidence disappears faster than liquidity during panic-driven market crashes every single time. Regulation reshapes risk but rarely eliminates underlying causes completely ever in real systems. Bankers knew risks, but incentives rewarded ignoring them consistently over time again today. Risk models assume normality in systems that are never truly stable at core. Small shocks accumulate silently until they suddenly become impossible to ignore completely ever. Liquidity dries first in shadows before headlines notice anything breaking at all suddenly. By the time panic spreads, exits are already overcrowded everywhere globally instantly now. Crashes accelerate as forced selling triggers more forced selling loops again suddenly now. Everyone assumes safety exists until leverage reveals hidden structural weakness instantly during stress. Panic spreads faster than information, reversing normal market behavior patterns completely every time. Central banks intervene after damage begins, not before collapse starts, always too late. Low interest rates encourage risk-taking beyond rational expectations levels again and again. Asset bubbles form slowly, then suddenly detach from underlying reality without warning signs. Markets hate uncertainty more than actual losses during stressful periods, always it seems. Herd behavior amplifies small errors into systemic failures very quickly, every single cycle. Credit expansion hides fragility beneath surface growth until collapse arrives unexpectedly each time. Every crisis looks obvious in hindsight, but invisible in real time, always initially. Speculation replaces productivity when optimism dominates market psychology cycles upward over and over. Exits become crowded only after confidence has already completely evaporated in panic mode. Narratives change faster than fundamentals during accelerating financial collapses, almost every single time. Liquidity shocks spread globally within hours due to interconnected markets, now more than ever. Ancient economies experienced similar boom and bust cycles repeatedly over history, clearly documented. Modern finance is faster, not fundamentally different from historical systems in structure itself. Information spreads instantly, but decisions still lag behind reality in dangerous ways always. Algorithms trade faster, yet still amplify human emotional behavior patterns without changing outcomes. Volatility increases when speed outruns understanding of underlying risk structures in modern markets. Small miscalculations grow rapidly into systemic stress under leverage pressure again and again. Feedback loops transform corrections into full-blown collapses quickly in modern financial systems. Every cycle begins with optimism, innovation, and easy credit expansion, almost predictably so. Eventually, speculation overtakes fundamentals, driving unsustainable price acceleration phases, as history repeatedly shows. Corrections feel sudden, but actually develop gradually beneath surface tension every single time. Confidence collapses faster than fundamentals can adjust to new reality, almost always now. Pricing disconnect grows until markets can no longer justify valuations at all anymore. Panic selling begins when liquidity evaporates across interconnected financial networks very suddenly indeed. Overconfidence is strongest precisely when risk is high again, historically speaking. Investors chase returns while ignoring deteriorating underlying risk conditions in pursuit of gains. Warning signals are visible but dismissed during strong upward trends, almost every cycle. Crises feel unpredictable only because timing remains inherently uncertain, always in real time. Leverage magnifies both gains and loss expectations levels significantly every time. Each crash rewrites narrative, making past risks seem obvious only in hindsight though. But during formation, same risks appear invisible to most participants in real markets. Markets operate on belief, not certainty, making cycles inherently unstable by design, always. Fear spreads faster than rational analysis during downturns in finance, almost instantly now. Liquidity disappears first in shadow markets before mainstream recognition arrives, every single time. Systemic risk builds invisibly within complex financial interdependencies globally over long time periods. Crashes are not events, but processes unfolding over extended time frames, in reality, always. When confidence breaks, everything previously stable becomes suddenly fragile in markets, instantly, again. Central intervention often delays correction, but increases future instability risk significantly over time. Short-term incentives dominate long-term stability in financial decision-making, always, eventually. Economic cycles repeat because human psychology does not evolve quickly at all, really. Every boom contains seeds of its own inevitable reversal phase, without Markets forget past crashes faster than economies recover from them, historically speaking, always. New participants enter markets without experiencing prior collapse cycles, in most cases now. That memory reset ensures mistakes are repeated across generations, again and again, always. Technology speeds up transactions, but not human error tendencies in financial systems today. Faster markets create faster mistakes with amplified consequences globally, very quickly indeed now. Small shocks today become major crises under leveraged conditions almost instantly, always now. Each crisis leads to new regulations, never perfect solutions in practice, ever really. Those regulations gradually become part of next systemic imbalance over long